Welcome to this explainer. We're grabbing our analyst's magnifying glass today because we're looking at how inventory accounting can completely warp a company's financial reality. If you thought the inventory number on a balance sheet was just a simple, objective fact, well, you're definitely in for a surprise. So consider this fascinating premise. Is it actually possible for two completely identical companies to report wildly different profits just based on how they count their inventory? The answer is a massive, resounding yes. You see, inventory isn't just boxes sitting idle in a warehouse somewhere. It's a highly strategic accounting tool that directly impacts profitability, perceived efficiency, and yes, even executive bonuses. To solve this mystery, here is our agenda. 1. Valuing the inventory. 2. IFRS versus US GAAP. 3. The inflation effect. 4. Measuring efficiency. And 5. Decoding disclosures. Okay, let's jump right into Section 1, Valuing the Inventory, the baseline rule. The fundamental law we need to establish right off the bat is that inventory must be measured at the lower of its historical cost or its net realizable value. So what's net realizable value, or NRV? It's basically what a company actually expects to pocket from selling the item in the normal course of business, minus any cost to get it out the door. And this rule exists for a very good reason, right? It stops companies from overstating what their assets are actually worth. If your inventory loses value, you have to face the music and admit it. Which brings us perfectly to write-downs. Say your inventory spoils, or it becomes technologically obsolete, like think of last year's smartphones. Or maybe selling prices just drop across the board. The carrying amount on the balance sheet literally has to be written down to its new, lower net realizable value. For us as analysts, this is absolutely crucial because that write-down triggers an immediate expense on the income statement. It's a direct hit to the bottom line. Moving on to Section 2, IFRS versus US GAAP, the first clue. Now, here's where things get really interesting. When you're comparing global companies, you're often dealing with completely different rulebooks. Let's say market conditions suddenly improve and that written down inventory from earlier regains its value. Well, under International Financial Reporting Standards, IFRS, you can actually reverse that write-down, which effectively boosts your reported profit for that period. But under US GAAP, no way. It is a strict one-way street. Once you write it down, it stays down. So a European company and an American company could experience the exact same market recovery, but report totally different results.
Oh, and as a quick, kind of surprising twist, there is actually a rare moment of agreement between the two standards. For very specific commodities, like gold bullion or agricultural products, they get a special pass. Because they trade in active, highly liquid markets, they can actually be marked up to their current market value, no matter which standard you're using. It's a really cool exception to the usual conservative accounting rules.
Right, let's head into Section 3, the inflation effect, the financial time machine. Think about an inflationary environment for a second, because that's what we see most often in the real world. When prices are climbing, the accounting method a company chooses literally dictates which costs hit the income statement. If they use FIFO, first in, first out, they're matching older, cheaper costs against current sales, giving them a higher reported gross profit. But if they use LIFO, last in, first out, they use newer, more expensive costs. That results in lower reported profits. Now, that might sound bad, but it actually gives a much more accurate picture of current costs on the income statement, and it often saves a company a ton of money on taxes. Let's put this into perspective with a side-by-side comparison. Imagine two absolutely identical companies. Same sales, same purchases, exact same physical reality. Yet, if you calculate the numbers, the one using FIFO looks way more profitable after year one. Why? Simply because the LIFO company's costs are increasing with inflation and hitting the income statement immediately, while the FIFO company is just passing those older, cheaper historical costs through. The operational reality is identical, but the financial reality is entirely an illusion created by the accounting method. But wait, what happens if prices are falling instead of rising? If we hit a deflationary environment, like in the tech sector where component prices can drop over time, the whole thing flips upside down. Suddenly, FIFO reports lower gross profits because those older, higher costs are hitting the income statement first, while LIFO actually looks more profitable. As an analyst, you literally always have to cross-reference the inventory method with whatever the macro economy is doing. Okay, Section 4, Measuring Efficiency. Interrogating the ratios. Keeping all these accounting quirks in the back of our minds, how do we actually figure out if management is running the warehouse well? Well, we rely on two inversely related tools. First, inventory turnover. This tells us how many times a company's stock is entirely sold and replaced over the year. Second, we have days of inventory on hand, or DOH. That just translates turnover into how many days, on average, a piece of inventory sits around gathering dust before someone buys it. Generally speaking, a high turnover means things are moving fast. But remember those write-downs we talked about? A real-world example of the Volvo Group perfectly shows how write-downs can totally skew our analysis. When Volvo calculates their ratios using their as-reported numbers, which includes a massive allowance for inventory obsolescence, the metrics look one way. But if you strip away that allowance and look at the raw numbers, the ratios shift completely. To put real numbers on it, Volvo's reported inventory turnover of 5.04 actually drops to 4.71 if we remove that write-down allowance. Why does that happen? Because the write-down artificially shrank the denominator, the average inventory, in our equation. So the crazy part is, the very act of having obsolete written-down inventory actually made Volvo's management look more efficient on paper if you only check the raw ratio. This is exactly why you have to dig deeper.
And that leads us to a huge analytical takeaway. A high turnover isn't automatically a victory lap. It really needs context. Sure, it could mean highly effective, lean inventory management, but it could also mean the company has terribly inadequate inventory levels and is constantly risking stockouts, lost sales, or production shortages. You've always got to check turnover against industry sales growth to make sure they aren't just running out of stuff to sell.
Finally, let's wrap up with Section 5, Decoding Disclosures, the paper trail. Financial statement disclosures are the analyst's best friend. This is the paper trail where companies actually have to confess which accounting policies they've chosen. You're hunting for whether they use LIFO or FIFO, how their inventory is split between raw materials and finished goods, and most importantly, the dirty details of any massive write-downs or reversals that might be secretly warping their efficiency ratios. And if you're looking at a U.S. company using LIFO, you need to be on high alert. Our source material issues a pretty stark warning about this, stating this inventory reduction may generate earnings without supporting cash flow, and management may intentionally reduce the layers to produce specific earnings benefits. What that quote is warning us about is a highly controversial trick called LIFO liquidation. Basically, if a company intentionally stops buying inventory, say they just freeze purchasing at year-end, they are forced to sell stock from years ago. Because they use LIFO, those older layers are finally tapped. If there's been inflation, those old layers have ancient, dirt-cheap historical prices. Matching those tiny costs with today's high sales prices creates this sudden illusion of massive profitability, but it has absolutely zero underlying cash flow improvement. It's basically an accounting mirage. Which brings us to our final thought. As you evaluate financial statements moving forward, I want you to keep this question in your head. Are a company's profits a true reflection of their operations, or just a carefully crafted product of their inventory methods? Because now, you've got the analytical toolkit to look right past those top-line numbers, dive straight into the footnotes, and find the real answers hiding in the warehouse. Thanks so much for joining me on this explainer, and happy analyzing.